Welcome to Shortview Trading. This is your morning market hit for the first day of the second quarter, Wednesday, the 1st of April. What matters today for traders? Well, the S&P yesterday struggled to get above its key Fibonacci level, the 38.2% retracement level that you can see on the chart in front of you now. And it was a similar situation for the Nasdaq, as you can see in the chart of the Nasdaq Fibonacci levels. Various other indices around the world have been sideways range-bound for the last 4 to 5 trading sessions. That includes the DAX, the Hang Seng, and the South Korean Kospi indices. Albeit they've been in a wide range, but clearly in the last 4 or 5 trading sessions, very much range bound. And with that, there's one or two exceptions like the Nikkei, which overnight has rolled over quite sharply, currently down just over 5% and trading below the bottom end of that last 4 or 5 day trading range, as you can see on the chart in front of you now. We think there are 3 key factors behind that. Firstly, if you look at the size and duration of this initial relief rally, it's consistent with what we saw in prior stock market crashes, as we've been articulating over recent daily videos. In the great crashes of 29, 87 and 2008, the initial relief rally lasted between 5 and 8 trading sessions, with the market moving between 9 and 21% higher. As you'll be aware, we're currently entering the 7th trading session from the major lows at the beginning of last week, and from closing low to closing high, the S&P had rallied 17%. So we were firmly in that range of normal initial wave 2 relief rallies. The second key factor is what's been going on with our models. As you can see now, many of them have flipped very sharply from buy back to sell, or indeed strong sell. Our risk appetite scoring system, our combined RAG1 and RAG2, both key risk appetite models, have moved sharply from buy back to sell. Technically, the market was oversold. It's now very overbought. Whilst added to that, downside put protection's been taken off in portfolios. Third is the lower volume levels traded in the S&P that we saw in the past week. The normal playbook in capitulation is heavy volumes in the final selling, but also in the relief rally as well. The key question now is whether the S&P is range bound or whether it's rolling over. And what will be interesting to watch over the next few trading sessions is how it behaves as our risk appetite models unwind their sell signals. For full detail of how we're approaching these markets on a 1 to 2 week time frame, please see today's daily RAG, available to subscribers and on the website. So what are we watching today? Well, many of those key factors we've been outlining over recent days. Continued signs of stress in the financial system, whether it's easing or retightening. Added to that, the price action is key, as we outlined in the video, range bound or rolling over. Furthermore, we're interested in what policymakers do or don't get up to today. Whilst as laid out yesterday, the macro is starting to get interesting. Today we have US car sales for March, which will be down sharply. On top of that, we have ISM manufacturing, and there's also a whole bunch of PMIs for the manufacturing sector out across the globe. So that's it from us. That's your morning market hit for Wednesday, the 1st of April. Please do subscribe on YouTube, LinkedIn, Twitter and or Facebook. Thank you for listening and stay safe.